Hello, everyone. Darrell here from the Wealthspire Investment Team, back again with our June installment to our Markets in 2 Minutes series. It feels like things have been coming at us very quickly this year in terms of the financial news cycle, but one of the biggest bits of news last month was that Moody's announced that it was downgrading the US credit rating from AAA to AA. This captured a lot of headlines, likely for obvious reasons, and it triggered some pretty sensationalized news coverage, but in many ways it was a long time coming. Moody's was actually the last of the three major credit ratings agencies, with S&P having made this adjustment back in 2011, and then Fitch followed up with the same adjustment back in 2023. So this really didn't come as a shock to markets, but it did really permeate through the news cycle. And the interesting thing here is that there is actually now 9 countries that have been able to sort of outlast the United States and maintain that AAA credit rating from all three major agencies, with Australia, Denmark, and Germany among them. But what we want to focus on today is what investors in the US should be thinking about with regards to all of this. And what Moody's cited in the course of its report is two things. One, the deficit, which you see on the right-hand side here, which has continued to expand in recent quarters. And then also interest expense as a percentage of GDP, which we're showing on the left-hand side. And that has also moved considerably higher as interest rates have gone up over the past couple of years. And these two things in concert, both trending and even accelerating in an unfavorable direction, are what prompted Moody's to revise its rating. Now, the important thing to remember is that credit rating agencies have no control over market function, and they don't directly influence debt markets, right? They're just providing their own assessment of credit risks in the form of their ratings. But for all practical purposes, it's the market's interpretation of things that matters most. And for the markets, this was very much a non-issue. For one thing, it was largely a formality in the sense that both S&P and Fitch had already made the move. But beyond that, this sort of change only becomes material if it actually impacts the government's ability to borrow. And if there was any material change to the outlook that markets anticipated from this, it would show up in interest rates. And here you're looking at what is probably the most closely watched bond yield in the world, the 10-year Treasury, and you can see that after the downgrade, there was essentially no change in the trajectory of that yield. And so the market is not assessing the US government's credit quality any differently than it already had been. Now, from our perspective, this is certainly not a positive development because it reflects a broader lack of discipline that is likely to have impacts further out in our future. But as far as this singular event goes, it really hasn't changed a thing. We do watch government debt levels closely and factor these sorts of things in when thinking about long-term economic growth and how that may influence markets. But for now, we're not making any adjustments to the way we think about the US economy, its resilience, or even how we think about bond markets. If any of that changes, we'll be sure to communicate that in future iterations of this series. But until then, we hope you all have a great start to summer, and we'll see you in July. Thanks.